Mortgage rates dive to 6% as housing market shows sense of optimism from Realtor.com.
Yep.
Now, we have seen this firsthand, and even below 6 for those government loans. So for specifically VA, which we do a ton of VA loans, and right now a lot of VA IRRRLs and VA cash outs. This obviously is a historic cut because we've had such a prolonged time of interest rates being, let's say, high or elevated.
Yeah.
I'll say elevated in this little window of time, the last like maybe 10, 15 years, but not elevated when you look back at the 80s. You're going to stretch all the way back to the 80s, and you're going to go, oh, but houses were 18%. They were also 40 grand. I think the rates coming down, we talked about at the top of the show, it's mostly baked in. The market was expecting it. Yeah. There was some market things that were happening in the Japanese bond market and the United States side that was causing there to be some immediate change in their 10-year yield, which then brought all bonds in that same direction. And so I think we were benefiting early from some of the rate change in August, even though the Fed rate change now has happened in September.
And again, that we talked about this last week. People think, the regular consumer thinks that when the Fed reduces the Fed funds rate, rates go down, interest rates. No, what happens is that influences how we're borrowing money, how the banks borrow money from the Fed. Also influences, like HELOCs, credit cards. We talked about car loans. It does have influence in the mortgage because it has an influence to the 10-year treasury. And that's how we get our mortgage rates, right, Andy?
Yeah, from the mortgage-backed security market, yes. And it trends very tight with the 10-year yield. So when you see the bonds move in a certain direction, mortgage rates typically follow that same direction.
Yeah.
And so like we talked about last week, when there's more money that comes into the system, it becomes less expensive to lend out.
Yeah.
When there's scarcity of money, it is more expensive to lend out. So that's kind of like the essence of it. But what I'm bringing up here for people who have not been following this kind of storyline is that the summer wasn't really the summer.
Nope.
I think the fall is going to be our summer, where people are now off the sidelines. Inventory's coming back up. Mortgage rates are going down. I do think that some people are waiting on the sidelines for the election because they're like, who's going to win, person A, person B. But I think this is a great sign because I think it's going to motivate some people to actually take action. Where they're waiting for the Fed to do something, where they're economically, let's say, close enough or curious enough to know that the Fed's making some plan. They're cooking in the kitchen. Now that they've done what they've done, okay, I think some people are going to show up. I think we're already seeing it. I mean, that's what's happening.
I feel a good amount of people finally said, like, okay, I think they're going to stop raising rates, so let's start creeping back in, but still slowly be cautious about what's going to happen, because they mentioned if inflation stays controlled, we can expect rates to continue to come down. But if any sign of inflation coming up higher, we could go right back up and they could raise rates again. So I think it's just taking it day by day, understanding the data, and just making decisions based off your plans and not timing it and trying to say, hey, I want to get a good deal to roll the dice.
Go ahead. No, go ahead.
Yeah. Although when I see this 0.5%, I got excited.
Yeah.
Because we were all really anticipating 0.25%. And then it was crazy. For the last couple of weeks, like 68% of the people said it was going to be 50 basis points. And like 23 thought it was only going to be, 25 basis points. So seeing this 50 just gets me excited, but also gives me concern, right?
Side eye.
Because, it's like, okay, it went that drastic. And we already know a lot of market conditions can influence that decision.
Yeah.
Right. So hopefully the Fed is getting it right to have made that type of movement this quick, with the 0.5%. And I know that you were talking about earlier about another quarter to two more
quarter point cuts.
So that would be pretty crazy.
So here's what's curious to me, guys, because they specifically use the word in the title, sense of optimism. And it reveals to me how sensitive we are as consumers. On the consumer side, I think people who are, let's say, well enough aware of what's happening to know when to strike when the iron's hot or when to wait, it really does reveal a personal, behavioral or even psychological sensitivity to market conditions.
Oh, yeah.
And I think that we don't talk about it on the optimistic side a lot. It's always on the negative side. It's, people are on the sidelines waiting. Affordability. And I mean, I'm admitting that we're the ones saying that. Like we're delivering the bad news because that's what there was. It's just hard.
But
yes, rates were the highest they were in 23 years. Yes, affordability is at an all-time low. Right. So I think the sense of optimism is warranted.
Yeah.
I guess what I was trying to say. It's warranted, number one. Number two, I'm glad to see it. It makes me optimistic about what the future of housing looks like. And even though these conditions have changed, we're not seeing prices plummet. They may be softening, but they're not plummeting and they haven't fallen off a cliff. And I don't know if they will, because the current inventory is just absorbing the demand that's already there.
Yeah.
And there's going to be still continued demand because now affordability is going to ease up and people can get these rates that we're now offering in the market.
No, exactly.
So
exactly.
I read something interesting by the Chicago Fed President Austin Goolsbee that he mentioned over the next 12 months, we have a long way to come down and get to interest rates to something like neutral, is what he said. And the median Fed forecast puts neutral at 3%.
Yeah.
So I'm interested to see, how close we get to that, because they said 2% for inflation. So
that's a ways away.
Exactly.
Yeah, that's you're talking about inflation or the Fed funds rate at 3?
Fed fund rate at
Fed funds rate at 3%. Yeah, it's at 4.75 right now, right?
So
Yeah.
So okay, if we're at 4.75, we get 2 more quarter points by the end of the year. We'll be at 4.25. That means there's still a 1.25 left to get to 3. That might be an interesting 2025.
Yeah.
That would be real.
Yeah.
I don't know. Do you think that's too much? Do you guys?
so.
Do you? What do you guys think? Like you're again. I know you know I'm going to ask you this, but do you think that's too much if we go Fed funds rate all the way back down to 3?
I think it's too much. I don't think we're there
might
yet.
break something.
Yeah, not right away. But I mean,
Yeah.
do you think that over the next like 12, 18 months that we go?
I think like 18 months. I think 18 months. 2026 is where I think we'll see that.
Okay.
So they said
Not
that
2025.
By Q1 2025, it's expected that mortgage rates are expected to be around 5%.
I think people are going to love that. I mean, obviously, the answer always is going to be, the lowest ever. The lowest is better, right? Okay, we get that. If 4%, I think would just go bonkers. I think prices would skyrocket at 4%. I think 5 might be a nice barometer where, again, maybe using the neutrality word, maybe that's what he's talking about. I'll piggyback on that and say, I think there's some neutrality in that at 5%. I know right now with, again, VA loans, we're already in those 5s, the 5 range, and based on the loan amount, that's certainly true. But I think 5 o'clock. I think 5%. Hey guys, is it 5 o'clock yet?
Almost.
I think 5% is like psychologically key.
Yeah.
It's a nice even number people can grasp onto. They go, okay,
5 is healthy.
5%. I can get. It's not 7.
Yeah.
Okay,
Closer
3.
to 8.
3's in the rearview mirror. We missed it. We're not going to get 5. I could deal with 5.
It's just any rate reduction right now is a huge help to that new home buyer or that person looking at refinance. A 0.25% is going to take them anywhere from like 100. I'm going to say between $80 to $120 of savings a month.
Now, do you guys think this is going to help home builders more than it will help existing home inventory? Do you have have you thought about who do you think that's going to benefit more?
Yeah.
Because you have the build time if you're a builder, and then you have the existing homes that may need to be upgraded or modernized. So there's kind of two different products on the market.
I think, here's the thing. With the new home builders, the great thing about that is they're going to leverage a new property. They already know what their bottom line is, so they're going to be able to negotiate like 2-1 buy downs, 3-1 buy downs, where most sellers that's their departing home, and so they're like really emotionally tied to it. So if they give a $20,000-$25,000 credit, very hard to extract that from them. Whereas a new builder has no emotions with it. They're just looking at like we have to move inventory. We have to get our partners the money that they need to. So I think it's very different.
Yeah. Okay.
So I think for me it'll help more.
No, I'm right on line with you. I think builders have a higher capacity of being able to move inventory and shake up the market. Whereas a seller would say, I'll wait until somebody comes and buy my house. Like it's okay, I'll keep waiting. Whereas the seller's like, well, sprinkle some money in there, get some credits, and let's get.
You know what's funny with that with the brand new builders is they were started practicing that whole NAR, not paying realtors commission for like the last couple of years.
Oh yeah, and if
not,
you
really
get
think about that,
or you get a finder's fee.
Yeah,
yeah.
Like that's all. They're not willing to pay that because they rather entice the home buyer, come on your own, and we're going to give you greater incentives. Well, we're giving them, we're going to give it to you. So I think who benefits a lot is going to be new builders.
New builders?
Me. Yeah.
Okay. All right. So new builders are going to have the upper hand in a reduced rate environment.
I think so.
I agree because in a world where everything's expensive and they see a new house compared to a house that needs some work, and then they're incentivizing you to buy the new house. I mean, as a consumer, you're going to be like, well, I'll go with the new house. Like
now, if you're in Chula Vista, right, in our area where there's a Melrose, that could be very disheartening because then the taxes, you're talking about almost 2%. Yeah. And when the median sales price in this area is like $850,000, the taxes alone would just clobber you.
And then you see prices like nice medium price houses like $750, $780, and you're like, oh great, this is awesome. But then you go and do the numbers. HOA is going to run you $450. Your property taxes, like you said, ended up being like $1,400. So there goes your savings, and now you're actually paying more than if it was a regular house.
Yeah, I think in general, what will happen is existing sellers are going to start listing their homes more. I think that because again, the second they are selling their house, they're the buyer, so they have to go hit the market. And I think part of what we saw kind of inadvertently happen is traditionally it's like, oh, when rates go high, listings shoot up. Well, that just wasn't the case here because everyone's just listing their homes got 2% loans or 3%.
Exactly.
That golden handcuff. So now it kind of like had maneuvered a little bit, and you're like, hey, the high rate environment is actually keeping people on the sidelines. Now that rates are softening up a little bit, I think you're going to see more inventory. We're already seeing that happen.
It's
more
already there.
inventory, but also longer list times.
Yeah.
So I think sellers eventually are going to win. Not all sellers are going to be competing with new builders because there's some places that aren't building.
Yeah.
And so all there is existing inventory. And those sellers are going to be competing with each other, not seller versus 10 buyers. It's going to be, you'll have 10 buyers on your place, but also so will the next guy. And so they're going to have to start competing. Who's got the better house? Who's got the upgrades? Who's got the price? Who's got the scenario? And I think that's what we're going to start seeing a lot more of the fall and even through the winter.
Yeah.